All right, I think we're good to go. Is that Matthew? Guess I can get off him out. Was it like a cleaning person? Was it a cleaning person, like banging up against the door? Okay. All right, today we're gonna talk about crypto market basics as our continuation of the finance and crypto series. So today we're really gonna try to understand like the nuances of the crypto market because it's got some differences from like traditional markets like the stock market and all that. So first we start out like with basic markets. So it's just a place where people buy and sell things. And over time, it's become really sophisticated. You got things like the stock market, commodities market, foreign exchange. We can imagine that like we have like these exchanges where people, well, I guess a couple decades ago, people would be like yelling and stuff in the pit.
Yeah, pit trading.
Yeah, pit trading, that's the word. But nowadays it's all pretty much all electronic. A lot of physical venues are like closing down and just switching to just full electronic. And now we have like lots of like high frequency trading and stuff like that from computers and all that. So now we have the crypto market in this new day and age, very sophisticated trading in these markets. And so as a result, in this new market, there's lots of volume traded per day, and there's lots of different market structures that are unique to crypto that have developed, which we'll take a look at in a bit. So first thing that's like interesting about the crypto market is that it's pretty correlated to the overall market. So Bitcoin's correlation to the S&P 500 has been increasing. And lately Bitcoin tech stocks, including other risk on assets as well, tend to move together. And basically risk on assets are just assets where investors put their money when their risk tolerance is higher. And when market and economic conditions are good, investors put their money in risk on assets. But when there's a downturn, investors tend to take away their money from risk on assets and put them into less risky investments. And so another thing is that Bitcoin has high beta compared to stocks. And beta, if you don't know what that is, it's basically a measure of how much an asset moves on average when the like overall like market or whatever it's compared to increase or decrease. So if the stock market rises a little bit, Bitcoin will rise more in comparison. And then also altcoins are highly correlated with Bitcoin. So everything in the crypto market pretty much moves together. But altcoins have a high beta when compared to Bitcoin. So if you put that all together, the implication of the high beta in altcoins is that when the overall market is doing well, Bitcoin does better and altcoins will do even better. So that's something to keep in mind. So basically when you're trading alts, you usually want to do it in a bull market because you'll get the best returns then. And then also you want to take into account the trends of the market as a whole, just so like you're not betting on a altcoin you think is going to do great while the market is like kind of crashing because the alt might not do very good. So here's some graphics showing the correlation between Bitcoin and the S&P 500. So you can see in like it hit 0.55 correlation coefficient, I believe that's called. And so yeah, they are getting pretty correlated, which is understandable since they're both like becoming or Bitcoin's becoming like the mainstream and stuff like that. It doesn't really have a mind of its own. And then also what I was saying about correlation with tech stocks. So the NASDAQ, as you know, has a lot of tech stocks. And you can see from 2020 to 2022, the correlation has been very high. So that's a interesting thing because like in the past, like crypto has been known as just having like its own fluctuations, not really being correlated with anything else, but recently it's been very correlated. So any questions so far? Yes.
Do you know why there's like a dip in 2021? Like, especially in the previous graph, it appeared that for a few months,
Mhm.
there's decoupling from the market.
That's a good question. I don't know why. I'm blanking.
So usually like whenever the market overall, like, there's a huge drawdown, correlations go to one. So all equity markets, commodity markets, they'll all have the same correlation because they're all going down. And typically what happens is after a few, couple of months, like some things recover and some things don't. And so that's where you see like, negative correlations or, mean reversion where some sort of like stocks or, certain assets will continue, gaining the uptrend while others just continue lagging. And that's kind of where altcoins are like better performers when you start to see like a bull market.
Thank you. All right, so another unique thing about the crypto market is that they have different trading venues. So of course, like traditional markets, there are centralized venues, centralized exchanges. They use a limit order book model. They have more volume just because of the way that they're structured and just because people just tend to use them more. They're more accessible. And there's a lot more liquidity for like the most popular cryptocurrencies because most of the trading is done in the top ones, and then most of the trading is done in the centralized exchanges. And then centralized venues also have spot and derivatives, whereas where we compare to decentralized venues such as decentralized exchanges like Uniswap, for example, they use automated market makers instead of the limit order book model. There's less volume just because there's less people trading on chain. And then there's liquidity for more like obscure cryptocurrencies, like smaller like DeFi protocol coins. They'll have most of the liquidity on decentralized exchanges rather than being listed on a centralized exchange. And then decentralized exchanges are mostly spot. And so we'll talk about what spot and derivatives mean. And then so derivatives can be offered on the blockchain on some decentralized apps like DYDX, DopeX, Opine, Ribbon, etc. DYDX is perpetual futures. DopeX, Opine, and Ribbon are all options, I believe. And so more on what limit order book model means, if you're not familiar with that, that's basically the system where there's bids and asks. And so you can put an order saying like, I want to sell my Bitcoin at this price. And then that's called a limit order. And it's going to be like on the books. And then someone can take that trade. And then vice versa, you can take someone else's trade where if they want to buy Bitcoin at a certain price, you can sell it to them. Any questions so far about the differences? All right, cool. So next, let's talk about spot versus derivatives. So spot, basically what that means is just buying, selling the actual asset. It's like trading just raw shares of stocks instead of trading like options or futures or anything, you're just trading the actual share. And so usually when you do this, you can withdraw the asset from the exchange. So usually you would want to go to a spot market if you're trying to like invest long term. If you want to buy some Bitcoin to hold on for years, you just buy it from the spot market. And then derivatives are contracts whose value is derived from the underlying asset. So this is stuff like options, futures, perpetual swaps, and derivatives. They allow for leverage. There is leverage for spot, but you can get way more leverage in derivatives. We'll talk about leverage later. And most of the volume in crypto trading in the markets is in derivatives, specifically perpetual futures. So that means that derivatives are the most liquid because most of the money being traded is in perps or perpetual futures. So here's another comparison from traditional to crypto.
Yeah, so typically options market, we're looking at traditional finance like the S&P options market. You'll typically see that leading over compared to like the spot market. Usually anyone that is moving size, like they'll typically purchase things on the options market, and that will dictate a lot of like the flow in price predictions in the future. Delta One is basically spot markets. It's just like a fancier term for that. But in the crypto markets, Delta One, like perpetual futures, are what's usually traded. The market hasn't really matured, and the reasoning behind that is crypto market is still fairly new. It's like in its infancy. So a lot of people are not really developing options market exchanges where everyone can trade on. And there's a lot of reasonings behind that, like KYC, like there's not a lot of users that can be onboarded. And the reason behind that is regulatory issues with the SEC and whatnot. And so once we start to see a lot of onboarding and what FTX is planning to do with like creating their own exchange that has derivatives access for US customers, then we should start seeing where crypto options flow will be more important to pay attention to.
Yeah. Actually, can you sort of elaborate on the first point about option market leading underlying asset and what it means for like everyday traders, for instance? What does it mean for them?
Good question. Yeah, so basically what crypto options like leading, options leading the market means that previously what you would see is when someone wants to buy something, they'll buy like options because there's a lot more leverage and convexity in their positioning. If they're think of it this way, if you had information that was an edge where you knew something that was going to appear or kind of had a higher certainty of what's, higher probability of something to occur, you would rather go where you can get convexity and like leverage, and that can multiply your returns. Typically what investors will do is they'll seek areas where they can multiply their returns if they understand their edge, like how much they'll make when something is trading at that. And so they'll go to the options market. And what's been happening is when there's like this huge influx of people going into the options market, they call it the tail wags the dog, where now the options market dictates everything. The flow matters more than what anyone is trading on the underlying, because not a lot of money is in the underlying, it's more in the options derivatives.
Can you explain what convexity means?
Yeah, convexity is mostly, you guys understand the shape of convexity, where a position that you have. And the simplest way to explain it is options have a certain like Greek values like delta and gamma. And typically what delta is measuring the options price over the stock price. Taking that delta, you do the second derivative of that. That's basically your gamma. It's more of a measure of your stock price. Whenever the stock price moves and your delta moves, then your gamma is gonna increase as well. It's not really constant slope, it's changing. And typically that's where convexity comes in, where a lot of positions, they're non-linear options. That's how you have to think about it, where your position isn't the same as it was previously. It's always changing at a not a constant slope. So computing that slope will tell you exactly what options, how much exposure you have and like the cost of your positioning and whatnot.
Thank you. All right, so like I said before, perpetual futures are the most popular instrument for trading crypto. So that's what we're going to be focusing on here. So first, we got to understand what a futures contract is. So futures contract is just an agreement to buy or sell an underlying asset at a predetermined price at a specific date or an expiry in the future. And so a perpetual futures contract means it has no expiration date, which means you don't have to like roll it over. And so this was it's a new instrument developed by BitMEX, which is a crypto exchange in 2016. And so, like I said before, they're the most popular instrument in crypto trading, and there's billions upon billions of dollars daily in volume and open interest. And so because the contracts never expire, exchanges need to ensure future prices and index prices, which is the price of the underlying asset. They need to make sure that they pretty much become the same, because like contracts can kind of like diverge from the asset price that it's kind of deriving from. So the solution here is called funding. So the mark price, which is another word for the price of the futures contract, when the mark price diverges from the index price, one side of the trade must pay a funding rate to the other side to balance out the price. So that's just kind of like a simple explanation. There's a link to a longer explanation in the references. And so I'll post the slides later if you want to read more on that. And so basically the funding rate is just based on the difference between the mark price and the index price. So basically positive funding means that the mark price is above the index price. So that means the long holders are going to pay the people who have the short contracts. And then negative funding means vice versa. The mark index is less than the mark price is less than the index price, so that the shorts pay the longs. And so in the positive funding situation, they basically need to bring the price down to the index price, and then vice versa for negative funding. And then open interest is another term that's that a lot of people kind of pay attention to. And so that's the value of all open futures contracts. And so the open interest of one Bitcoin long contract and one Bitcoin short contract is a total of 2 Bitcoin of open interest. Any questions about this, Kwang? You're making some faces. Or
Can perpetual futures actually be redeemed?
that's a good question. I was wondering this too. I don't know if you know the question or the answer. I mean, yeah, usually, okay, so yeah, usually or I don't even know if ever they can be redeemed for an actual like asset. But one thing I was wondering is, are there actual like assets like backing it?
Each exchange has their own asset backing for it.
Okay, so they are
yeah,
backed.
Perpetuals are all different, like in terms, that's why you have like different perpetual for like Binance and FTX, and they all have like their own value and like mark minus index price.
Okay.
Yeah,
That's
I
fine.
mean, I had a bit of an issue understanding perpetuals early on. I think like a numerical example would be very helpful. I was wondering if you could like give us an
Yeah.
example of perpetual motion.
Wait, so do you mean in terms of like funding, or like what should I
Like showing
explain?
how like t equals to 0, this is the value of perpetual, and then at t equals to 1, the price move up, and what happened to the payoff of the perpetual owners. Yeah, if you could like show that, like it's numerical example of that, like that would be very helpful. But because of
Do you want to draw on the board? Because I don't exactly know like what you're talking about.
I think it's just explaining like when mark price is, for example, 50,000 for Bitcoin and index price is 45,000, and the funding rate is
Oh,
doing the difference of that and computing that. But I think that's good.
yeah, so just kind of illustrating the funding.
like
pretty much.
how the mechanism of perpetual, like how does it
Yeah.
work?
Okay,
Yeah.
so we can draw on the board, I guess.
Yeah, percent the conversion price. And then the mark price goes up, up, and up with it. Then you have the long and short perpetual owners, right? And then the long perpetual owners basically takes $500 and gives it to the short perpetual.
Yeah, yeah, and that's based on the funding is positive. So how you see market is greater than index in the long case.
Yeah, exactly. Even though like
Yeah.
this,
So what am I drawing here?
yeah, like the long, the short, how much they have in their wallet. And
Okay.
time equals to 0, and then the price moves and how that affects. it.
Okay, so let's say we're at time equals 0. So let's say the. Alright, what value should we start out with? Alright, what value should I start?
So, okay, you have long and you have short, right? You have some on their price.
So what is the Alright, so
Something where index is like a couple thousand, so like
market is what?
$40,000.
Yeah, so this is slightly different. This is a contract that the long and short enters in. What do you say? And infinite features, yeah.
38.
Alright, so 38. So in the situation, the mark is greater than the index. So that generally means that there are more long holders than short holders because they drove up the price of the contract to where that the contract price is greater than the actual asset price. So what happens is the long, to balance out this difference, the long holders need to pay, explicitly pay their funding to the short holders, and then basically that'll cause so that it'll balance out to L equal S one rate. So now so the funding rate, it's just for every contract pretty much, it's just it's 40 minus 38 is being paid for each contract, right? And then eventually
So then eventually market price will become index price.
So the index price is always fixed.
Yeah, I mean,
Yeah,
index price is what is supposed to track. Market price is where the perpetual future contract is trading at. So market price is different for every exchange. But then the index is, think of index as the underlying.
So the price of the underlying crypto
Is index.
price of Bitcoin.
Yeah, price of Bitcoin is the index. And then market price is whatever is being traded on based on these investors, whether they're long or short. If there's a lot of buyers that are selling short these contracts, then there's definitely.
How often is the funding fee or whatever paid?
Yeah,
So you're saying, so every day you compute the difference between your market and index.
right.
And then you take the money, one has to pay the other based on. the
Yeah,
price
based on-
of the-
It's like, the mark is like how many people have gambled one way and then they pay it out.
yeah, it's kind of like
Yeah, it's more like Paradigm has a good analogy where they say it's similar to basically a thermostat. If your thermostat is at like this, if you put it at a certain value, and let's say the outside condition, the temperature is like at a higher value or lower value, it'll try to use like a control system mechanism to make sure that it's always at that certain level, 70, whatever value that you put it at. And that's gonna be like the index. And then above and below, like wherever the outside like environment temperature is, that's considered your mark. And so it'll try to balance it out to become same as the index.
So then if the Bitcoin price just keeps going up, then the short would have to keep paying along over and over.
Exactly.
Yeah, they pay the difference.
Until the point to where it doesn't pay you to be short. It's not profitable. So people will switch. to being long.
Yeah, it's kind of an incentive system. pretty much.
I see what you're saying.
All right. So now we can see what the interpretations of funding and open interest are. Just a note, this is technical analysis stuff. technical analysis can't predict the future. It's just it's like, it's not to be solely relied on, some may say don't even like trust it at all. But it can provide some insight into market activity, what people are doing, because knowing what other people are doing can be helpful sometimes. So funding interpretations are not super straightforward at all. They need lots of context, or the funding rate needs to be put into context to kind of get anything out of it. But you can infer some the activity in the derivatives market based on context plus funding. So in general, if funding is skewed strongly in one direction, and so basically when this happens, when there's an imbalance, that means there's some aggressive positions, like people are like sizing up on one side and the price isn't moving in the direction that they want it to. The owners of those positions are not being rewarded because they're paying funding to take that like oversized position. And then if they're not being rewarded for that, then they'll back off. And then basically when they back off their position, when they close their position, it kind of causes the price to be pushed in the opposite direction. So for example, let's say the price is at support. So basically that means like the price is going up and down, and it's kind of like hitting a certain price level, but it's not ever going down to that price or going below that price level. So let's say it's like at that support price level, and then funding becomes more negative while the price continues to either go up or go sideways. And so here that means that the shorts are the so-called aggressors. They're the ones that are like kind of causing the imbalance. They're the ones that are hoping that the price goes down. But let's say the price doesn't go down. And so they're like, okay, well, this trade isn't working out. It's not worth paying the funding rate. So they close their positions. And so if you know how shorts work, when you close it, you have to pretty much buy the asset, and then that buy order pushes the price up. And so that's kind of how you can use context plus funding action to kind of guess what's going to happen to the price. It's kind of wish-washy, but I guess it works for some people. And so vice versa for price, if it's at the resistance, then there's positive funding. And then so open interest interpretations are more straightforward. If the price is going up and open interest is going up, then that means long positions are being open. Price up, open interest down, short positions are being closed. Price down and open interest up, short positions are being open, price down and open interest down, long positions are being closed. So you can see when open interest is going down, and that means positions are being closed, and then open interest up, positions are being open, and then price up and down kind of tells you whether it's like long or short that's being open or closed. So next we got leverage. Leverage is a big part of the crypto market. Whether, or in my opinion, kind of unfortunate. I don't know. It depends on your risk appetite, because I feel like a lot of people get wrecked when they try to use leverage. So basically leverage, if you don't know what it is, essentially it lets you increase your position size with borrowed money. You can borrow money from the exchange by putting up some collateral, or in other words, margin. And so the exchange will use that collateral they'll liquidate the collateral in case the trade goes wrong. So to make sure that the exchange doesn't, or to make sure the exchange gets paid back in full, they will make sure that they will liquidate you when the price hits a certain liquidation price, because they want to make sure that your trade doesn't go super wrong and then everyone's in debt. So let's say you have a long position and the price goes too low, it's going to hit the liquidation price, which is basically a stop loss. And so at that price, your long position will close, and then you're kind of out on all the money that you put up. Same thing as in a short position. If the price goes up too high, you're going to get liquidated. And so but also if the trade goes in your favor, you can multiply your returns. So if you have a long position and let's say Bitcoin goes up, then let's say you had like 3 times leverage, you'll make like 3 times the returns pretty much. So it's a good thing, but also bad thing. And so liquidation causes an event, or leverage and liquidation can kind of create an event called a liquidation cascade. And so that's when liquidations cause more liquidations. So let's say, for example, the price goes up. This is going to cause short positions to get liquidated, which means that the short position closes, which, like I said before, the short position closing becomes a buy order, and buy orders, as you guys should know, should push the price up. And when a lot of this happens, it's going to push the price up enough to trigger even more short positions to be liquidated. And it's just a loop of liquidation after liquidation. And so this is very common in the crypto market due to the abundance of leverage. So with the so lots of exchanges offer like huge leverage. So it's pretty easy to get liquidated if you're using large leverage. And then this can also cause quick and large price movements. If you are wondering why crypto has lots of ups and downs, it's pretty volatile very quickly. Part of that can come from liquidation cascades. And then exacerbating this is when market makers widen spreads to protect themselves. They kind of thin out the liquidity, and then that contributes to bigger price movement. That part you don't really have to worry about. But if you're interested in like market makers and stuff, that's kind of interesting.
Those of you guys who are vegetarian, there is vegetable fried rice. Everything else is not vegetarian, but if you guys want some fried rice, you guys can eat it.
Yeah, be sure to get some food.
Oh yeah, please don't cross contaminate. Like, can't get meat on vegetable fried rice.
Yeah, don't get meat on the vegetable fried
That'd be
rice.
the whole point of getting fried rice.
All right.
Yeah.
Wait, sorry. Should I go back to?
Okay.
Typically, due to the nature of crypto, there's a lot of like risk that's created by leverage traders. And as you know, BitMEX was one of the first exchanges where they had a ton of liquidations and a lot of traders that were accustomed to like 100x leverage. And a lot of that was very risky and dangerous. And when you have a lot of leverage traders, what happens is when the market starts to move a bit down or even up, it's just usually a lot of people that are very, how do I say this? They're super like sensitive to market movements. And what happens is like now they have to fill their margin. And if initially like the amount of money that they had doesn't even cover the amount that they have to pay, it's like gonna cause a liquidation cascade. What happens is this person now has to sell their Bitcoin or whatever asset that they're holding, and then the next person has to sell that. When a lot of this happens, you'll start to see a lot of margin calls and liquidations in the crypto market, especially since crypto markets is 24/7. It's not like the equity markets where there's a circuit breaker or there's a couple hours where you're trading from 8 to 3 p.m. And so crypto markets is 24/7. So you kind of have to be on the lookout at 3 a.m. when everyone's asleep or something, because something happened in another market area. And typically, this continues until there's a lot of leveraged traders that are washed out. And one thing to watch for is whenever you start to see like a high volume and exchanges that have a lot of leverage capabilities for their members, right? Their traders. OKEX and Huobi, typically they'll have a lot of leverage, and when the volume picks up in those exchanges, that's when you know like there's a lot of like risk on and like high risk appetite for a lot of investors. And over here, we can take a look at a lot of the leverage in real time, like 1 hour, 4 hours, and like 24 hours. It gets worse, like usually during huge market drawdowns. Like for example, May 2021, I remember it was like about 1 billion in an hour. And so here is like the total liquidation for all of these assets, and you can look at asset specific liquidations. It's not that much currently because there's not a lot going on, but there's a lot of crypto analytic like tools, websites to look at that you can track for free and see like where the areas in the market or certain assets that are being affected heavily.
Yeah, so historical information. You can see like some huge liquidations
Yeah.
there.
This is, yeah, they were long and $1 million Bitcoin. But yeah, that should explain cascading liquidation.
Yeah, so now we can go into another part of the crypto market. It's like away from the derivatives and stuff. Now we're going to look at more like on-chain kind of trading. So let's look at tokens here. Usually when I refer to tokens, I mean things that aren't really like blue chip things that are traded through like perps. So things that aren't Bitcoin, Ethereum, stuff like that. More like tokens that represent like DeFi protocols, things like if you heard of like Uniswap token, Maker token, just like small things like that if you're into DeFi. And so there's a bunch of different things that you can look at when you're evaluating if a token is a good investment. This isn't advice at all, it's just some data you can look at. So first thing that people tend to care about is the price, the price of 1 unit of the token. And so one thing in the crypto market is that there can be some variation between market to market because liquidity can be very low for like less traded tokens. And also one thing to note, price by itself is pretty meaningless when evaluating a potential investment. For example, let's think back to Doge Mania when Elon was getting on SNL. People were like, Doge is gonna hit $1. It didn't. Also, like $1 is just like kind of is a very mind-boggling number to someone who kind of understands finance a bit. Whereas a lot of people were thinking, okay, $1 isn't that much. Like $1 is pretty low. Like it should be pretty easy to hit $1, right? But no, Dogecoin has a very high supply. So $1 would mean a lot of money would have to flow in to push the price up. And then also just like in general, Dogecoin at its peak, like 70 something cents, like honestly, that just blew my mind. So congrats to people that won on that, but it's sitting at like 14 cents right now. We're gonna look at it in a little bit. Next thing, market capitalization. This is price multiplied by circulating supply. This represents the total market value of the particular token. This is another thing that is used in like the stock market and stuff. Like Apple has like a $2 or so trillion market cap, and so that's how like people like value a company. Circulating supply. This is just a number of tokens that can be traded on the market because some tokens may be locked away. Maybe like they're being vested, which means like they're kind of they were bought in like a investment round, and they can't be sold. They have to be like released over time. So that's what vesting means. And then total supply is just the amount of tokens outstanding. It includes, or this is just like the number of tokens, including locked tokens. But this excludes tokens that were burned. So burning tokens is basically usually just sending tokens to a certain wallet that's just like 0x000000. Nobody has access to that wallet. So sending your coins to that wallet means that it's just going to be burnt and just never accessible again. So you have to take into account that. And then max supply is just a hard cap on how many tokens can exist. For example, Bitcoin, the most tokens that'll ever exist is 21 million because it's just hard coded into the code. Continuing on, fully diluted valuation. So this is current price multiplied by max supply. And so this represents the market value of the token, or yeah, of the token if all the tokens were to be in supply. And so basically what that means is that, like, let's say, for example, this token X has like, let's say 1 million tokens in circulation, like that's how many are like possibly being traded on the market freely. And then there's an extra million that's locked, and it's owned by investors that like were early investors. They got in on like a seed round or something. And so they were given those tokens early, but they're required to like lock it for a certain amount of months. So the market cap for that would be just the price times 1 million, but the fully diluted valuation would be the price times 2 million, because there's 2 million in total, or 2 million that can possibly be on the market. It's not just total supply, it can includes max supply as well, which includes future emissions, future tokens that can be minted. So what does fully diluted value tell us? So this basically shows how much sell pressure you can expect as new tokens are introduced to supply, or as tokens are unlocked and introduced to the market. So a high FDV compared to the market cap means that there's a high potential for the newly emitted tokens or unlocked tokens to be dumped on the market and push the price down. So it's this generally known as a bearish event. And if you're invested in something with a high FDV, this is something to keep in mind, as it may not be good for your investment if like a venture capital firm like invested really early, and then their tokens get unlocked and all they care about is the profit. They may just dump it, and then you bought later because you're just a retail trader and you'll get absolutely dunked on. So there's also bullish unlocks, which a popular crypto Twitter figure named Kobe wrote about. And so this can exist, like not often, but it can exist if the holders of the to be unlocked tokens like happen to continue to hold it even if the unlock time hits. Apparently this happened with like Solana or something like that. And so when you remove the bearish catalyst, it kind of creates a net bullish event. So that's pretty cool. And then another stat to look at is total value locked. And so this is the total value of assets locked in a protocol. So let's take, for example, like Aave has like a lot of money locked in. It's a lending platform, so people deposit their assets onto the platform and then allow the platform to lend it out and stuff like that. And so this value, or this figure, really has no direct effect on the price, but it can indicate the health of a protocol. So if a protocol has like a really low TVL, like it's an indication that people aren't really using it, if it's like something that you'd expect to have like a higher TVL. And then it can also help predict future protocol revenue. If the protocol like takes fees based on the money going in and out of the platform, and then if the price is also correlated to revenue, then that's something you can also look at. Next, we have emissions, which just means new tokens being minted. It's same thing as just like printing money. It increases the supply, but it doesn't actually increase like real value. So just like inflation in like the United States, when you print more money, if the Like basically if the demand cannot outweigh the increase in supply, then inflation will occur. So in other words, your tokens will lose value if the demand for the token cannot outweigh the emissions. So knowledge of the emission schedule of a token can help inform your investments. And then some additional considerations: revenue. Does the protocol you're investing in make money? Is it tied in with the price? So like some protocols may do like a buyback with the revenue that they generated, similar to like a stock buyback. Utility, just fundamental analysis. Is it useful? Is it just a good idea to invest in it? Like, will people use it? Hype, a lot of price action in crypto is just directly related to, just sentiment, speculation, stuff like that. So hype can matter. So like, are you early? Are there future marketing plans? Because obviously a product needs to be marketed for the word to get out there, for people to use the product. So it's not all just speculation. Team, obviously the team behind the product is important. You want to make sure that they're reliable. Community, is there a real community? Are people only invested to make a quick buck? Community is pretty important in like blockchain stuff, because like let's say like DAOs, for example, DAOs can are really important for the like direction of a project a lot of the time. And then also you can, because everything is on chain, you can look at the top holders of this token. You can look at when they bought, and then you can also think about if you're their exit liquidity, like if they're an investor that's likely to sell as soon as it like starts pumping or something like that, and then cause the price to crash. So let's take it Bitcoin, for example. Price 41,000, about market cap $789 billion. Circulating supply about 19 million. Total and max supply 21 million, because the only time that new tokens will be introduced to the market is when there's a block reward generated. And so the fully diluted value is $861 billion. And so it's not too far off from the market cap, because there's only 2 million Bitcoin left to emit. And so emission schedule is 6.25 Bitcoin about every 10 minutes. And then that reward is halved every 4 years. And so my conclusion on this evaluation is the ratio between the fully diluted valuation and the market cap isn't too bad. It's pretty good. That like extra $100 billion wouldn't hurt like too bad if it were all just dumped, I guess. And then I expect future demand to outweigh any sell pressure of like the new emissions. And so based on that, I'd say maybe Bitcoin's a good investment. Not advice though. So you can look at CoinGecko, get all those data and stats, stuff like that. Yeah. So now let's take a look at different example. Dogecoin. Current price about 14 cents. Market cap $19 billion. Pretty impressive. Circulating supply 133 billion. So if the price would go to $1, like people were hoping it would, then that'd be a market cap of $133 billion. And oops, what's that? Trillions? Or what do you mean?
No, like the market cap would be at a trillion.
Would it?
If it was $1.
If it was $1?
You sure?
Well, no, because it would just be $133 billion. But let's take a look at like something that does have like $133 billion.
It's 14 cents, just multiply by cents.
Yeah. So that'd be bigger than, that'd make it the third largest crypto, which I don't know if Dogecoin has the utility really to make it to the top 3. So but that's just my opinion. And then the total supply, it's infinite. So that means there's just infinite inflation, kind of like the dollar. You don't really want to like hold on to the dollar because it just loses value. And so my conclusion is that Doge is very inflationary. I personally don't believe demand can really keep up with the increase in supply in the long term because it doesn't really have that much utility compared to other things. And like I said, it's kind of like similar to the dollar in that if you hold it, you're just kind of going to lose value. So I do not believe that Doge is a good investment, in my opinion, just my opinion. So,
My mom got rich off Dogecoin. You better not say.
really?
that to me.
Did she actually?
I mean, like, she couldn't sell it because then she would have to report it on her tax return. So she
Oh.
never sold it at its peak. So it just went down. I mean, she's still up by like a couple $1,000%. So
Oh, that's pretty
she
good.
invested very early.
And then just a couple thousand, huh? Okay. Well, anyway, so there's some tools. Abdullahi, if you want to show them off, you guys can click on the links once I post the slides in the Discord. But yeah, Abdullahi, show them off if you want.
Yeah, so the first one is mostly options like chain, so looking at different options like values and whatnot for different strike prices, and this is real time. And it's all free pretty much, so a lot of these tools, you can look at breaking it down into calls and puts and like open interest by certain strikes. Yeah, pretty much for a lot of option analytic stuff. They even got a guide to explain a lot of what it means for like being holding a call option or it requires a lot of like years of experience and whatnot, and it's really not, I would say, sustainable, especially for a solo trader or whatnot. But overall, like the tools is important to explain to you like what's going on in the markets and whatnot. And then coin analyze, same thing, a lot of different perpetual futures for different exchanges and then their prices and whatnot. So potential arbitrage between exchanges. It was easier back then, but now it's more automated. So there you go. And then this one is one of the, I would say, useful tools, although it's pricey. They have like a paid premium, but there was a lot of early indications of rugs or whatnot, like different NFTs that are dropping, whether there was anything important in crypto. Typically, they had access to wallets, so you could track wallets and see exactly where they're putting their money in. And that was like a crazy good tool, and it helped with a lot of like event-driven strategies where if you've seen something, a new token coming out or a new airdrop, where exactly is money funneling, and you can see where exactly exploits happen. So typically you'll you can kind of short the market or short protocol if you see that there's like a exploit or something. But yeah, that's pretty much it.
Yeah, so that concludes the presentation. There's some references to some stuff that we talked about, including like the guide to perps. And then also like the article that Kobe wrote about FDV. And then there's also a link to a document that I kind of took some, or that I got some info about like funding and open interest from like a big figure in crypto. And then so we also have a lot of new faces